private continues to compete with the public market. The private market is substantially larger than the public market, believe it or not. And they just haven't had a proper place to live with a proper structure or product to navigate it. You're starting to see that today. You'll also probably see companies stay in private mode than ever before. The mentality of founders today versus, say, founders in the 80s, 90s, even early 2000s was to go public as soon as humanly possible. That was the way that they could, bring things for themselves personally to fruition. Today, a little bit. Tomorrow, for sure, I think you'll start to see the secondary markets, take that over for them in their mind. Hey, I can actually have a liquidity event in the secondary market. I don't need to go public, which is a huge pain in the butt. It's going to cost me, my stakeholders, shareholders, a lot of money. It's going to be a lot of brain damage. It's just not that efficient. So they can use other rules and other regulatory securities exemptions within the local, locale that they're in to take advantage of basically product innovation. And it all comes together and it all is glued together if there are proper secondary platforms and activity out there. So that is a huge order. I don't think, that's a guaranteed, but that's where I see the market headed. And I know a lot of people are demanding for it to be a thing.
Welcome to the Early Advantage, where we unpack, undress, lay bare relevant financial topics that I guess need to be laid bare and talk about them. And today we're doing it with a 5 o'clock, more like a 2-day growth, not really a 5 o'clock shadow, which pales in comparison to my guest Chuck Pettid's nice two-tone beard, I'm going to say. I'm going to reintroduce Chuck in a moment, though. I'm really liking his beard. I'm guessing he's got some gold chain buried in a chest hair that we can't quite see. Anyway, let's talk about crowdfunding. Crowdfunding has exploded in popularity. I'm reading from a website, financefeeds.com. It says $7 trillion in 2021, going to $30 trillion estimated, but $30 trillion in 2030. That is a lot of money. And for perspective, U.S. overall market cap is 40-something, $45, $46 trillion right now as we speak. The publicly traded non-private industry. So it's still a lot smaller, but it is becoming a much, much larger minority or sort of counter market, so to speak. I'm searching for the better word here. Anyway, what does it mean for you? Should you participate in crowdfunding? Should you not? What does it mean for the economy? What does it mean for the future of companies trying to raise financing? Well, Chuck Pettid, who I've already pre-introduced, is joining me today. He is Executive Vice President at Republic.com, one of the largest crowdfunding platforms. So Chuck, welcome.
Thank you, James. I'm glad I can show off my 12-year shadow.
It is impressive. It looks good. I used to have one of these waxed handlebar mustaches when I was like 21 years old, which is really, really weird. And, you literally buy the wax to do it. And then it seems to be a lot of these millennials started doing it as well. And I thought, well, not that I'm against millennials, but I just figured I want to do my own thing. I'll just be kind of boring and mostly clean shaven. But anyway, back to crowdfunding, which I'm guessing most people have tuned in to watch us talk about today. Can you give an overview? Like, where are we now in the sense that there's a VC slump this year? I'm looking at some data here. The third quarter VC venture funding, at least in the U.S. for 2022 third quarter, totaled $81 billion. That's down by $90 billion from a year ago and down by $40 billion quarter over quarter. This is according to Crunchbase. IPO volume, by the way, is down 44% this year, and global M&A is also down 50%. So it's not just private market investing. Seems like everything is down. How is this affecting the crowdfunding industry overall? And where do you see the trend over the next 5 years?
Overall, you're still seeing an uptick in product market fit. If you look at, the UK does have about a 5-year head start on the US and North America when it comes to investment crowdfunding, but each has seen an uptick in volume, quality, volume coming both from the investors and the number of deals that people are seeing on platforms. And that's because there is better product market fit than ever before. If I look back in the history of it, especially the part that I'm familiar with and have been a part of, we've seen, numbers go from 6 campaigns to I'll do sometimes, 20 in 1 week. We'll have 250 campaigns this year alone, just in the North American side of our operation. On the European side, another 250. We'll see, total dollars raised from, mid 2015, 16s in the tens of millions of dollars to this year, which will be in excess of 250, 300 million US dollars of total raise. Now, that doesn't always, bode well for investors. They're putting a lot of money into these companies, but we're finally starting to see is these stockpiled companies from 2, 3, 6, 7 years ago are starting to come to exit. And you're starting to see an uptick. The trajectory looks like, the beginning of a hockey stick where there are exits and people are getting money back in their pockets. So that's the real super exciting thing that we're finally starting to see, along with that better product market fit for, investor activity, as well as, issuers accepting investment crowdfunding as a thing for them to do.
And just to jump in here as the secret decoder ring, if someone's new to this, product market fit is almost a code word for saying you're providing something people want. People want this, and it's going well. And from a 50,000-foot view, I think everyone's watching this is familiar with public markets. You go buy a stock, it's a security. It's traded on an exchange. There are a lot of rules about what you can and can't do if you're a listing company. Everything is closely regulated. And for the longest time, at least in the US, UK, and other markets, private markets were not much talked about. It was kind of the domain of venture capitalists, private equity people, maybe some high net worth or very high net worth individuals. That has changed. So if you're new to this, we're talking about investing directly in private companies, but in a almost like a quasi securitized way. In other words, you don't have to come in with a couple $1 million and go directly onto the capitalization table with your name. Some of these deals can be had for £100 or $100 or 50. I mean, it's basically the same as a stock price. Can you just give a little background on that? And obviously, I think the first question somebody might have is, well, wait a minute, all these rules about being public would seem to exist for a reason, the protection of investors. So
Yep.
What are the downsides? Because there are downsides, and I know people who are skeptical of crowdfunding, and I think sometimes with good reasons. So maybe walk us through the parameters of this.
Yeah, and I mean, and don't get it wrong, just because it's private doesn't mean it's the Wild West. There are parameters, there are regulations, there are a lot of regulations, to be honest. Companies like my own, as well as the companies who are raising capital from the public on crowdfunding platforms, have to go through regulatory processes, regardless of which securities exemption they use, which country they raise in, where they're domiciled, etc. So those are all put in place by security regulators and governments specifically to protect investors. Where you can get a lot of advantage, though, is working with companies, platforms who are bringing you these offerings, who have added additional overlays. They've been fiduciary, like they have fiduciary responsibility in mind, investor protection in mind. Where you get even better results is when you have a company who has those overlays in place, but they also have like-minded founders and companies, private companies that they're working with, who are equally protective of their investors. When you have that environment, you have more success, in my opinion. When companies are out there gunslinging and running around wild without much regulatory navigation and required, they can do things, in a pretty salty way. But when they have those parameters and they're also like-minded in thinking about parameters like that, they end up with a much more efficient and, professional offering like you see in the public markets.
Got it. So you do want to be careful and find the good companies, and probably part of that is that responsibility is put on the investor, and part of it is on the platform to make sure good companies list on the platform. I mean, in an absolute sense, obviously there are going to be more protections, like SIPC, and that. I mean, there are certain protections that you have in an open market, and sorry, on an exchange that you don't have in private markets, just pure and simple, right? But I guess your point is it's not as Wild West.
Yep. You do your homework. Look, if you have a brokerage account, you probably just don't open up the first one that you come across. You do a little research. You want to learn about the fees of the people behind it or what their actual services entail. That optionality and that differentiation is out there right now in the investment crowdfunding world. It's not just, down to 2 or 3. There's literally still dozens, if not hundreds of these platforms out there that give you access to private companies in an efficient way, but you still want to do your research and learn about these companies before you actually work with one of them, because the end result is you making an investment in something that may not have been what you thought going into it.
And who can do this? Maybe both in the UK and the US. I mean, I think generally you do not have to be a high net worth or an accredited investor anymore, or even a particularly sophisticated investor. Is that accurate?
That is accurate for the vast majority of offerings you'll see in the US, as well as the UK. You do not need to be what would be called either sophisticated or an accredited investor. Um, there are some protections in place for people, mostly just to not lose more money than they can afford to lose. So basic information is provided by the investor at the time of account opening. And again, those are coming either from the platform who's overlaid those rules into their product, or it's coming from a government, securities regulator. So they're there to protect you, basic information that you want to provide, so you're not, put in harm's way. So while you're doing your research, you can actually, gauge how professional a platform is based on how long it takes or what information they're asking for to open up an account. So super simple. If they're just letting you, open up the floodgates and say, "Hey, bring your wallet in, spend some money,
It's a bad
invest in this
sign.
and that,"
Yeah.
probably a bad sign. Yep. Um,
And you mentioned the word exit earlier. For someone again relatively new to this, if you buy a stock, you can basically buy it or sell it anytime you want, or anytime the exchange is open, I should say. In a private market, you don't have as much liquidity. You often have to wait a little bit. In fact, a lot of private equity funds are chartered with the idea of could be a 7, 9, a 10-year period of lifespan. We're going to realize these exits over time, and then we're going to close the fund and open a new one at some point. So how would you explain exits to the person new to this? Like, what's a good time frame to invest in these deals with in mind?
it's in the 7-year territory. The 7-year range is when you can expect something to go one way or another. Yes, there are some unfortunate incidents where companies will fail after 1 or 2 years, but typically you're going to see them last 5, and you're going to see, either a sign of life or no sign of life. And if they have a sign of life, they're probably going to exit somewhere in the 7-year range. And that can be acquisition by another private company. So you still have that illiquidity problem, especially if they do a stock swap. But obviously cash would be king. Cash swap would be what you'd want. Or if they go IPO, they go to a publicly traded atmosphere, then you actually have like another exit.
Exactly. They could go public. They
Yep.
could get bought out by a public company, get bought out by a private company, or they could just fail. All those are options. Yeah.
And on the liquidity front, I think what you're finally, starting to see too, is along the lines of that exit trajectory, is it's starting to pick up in our industry where there is becoming some liquidity. I've never seen it before in my 25 years in Wall Street and now in investment crowdfunding where it existed. Everyone always talks about building a secondary product and having a tool for people to exit, to trade freely. It hasn't been possible a lot because of either lack of licenses, lack of regulatory. And by licenses, I mean you have to have certain licenses from certain states, and it's very difficult to accomplish that. But some companies are coming together with them, and you're actually starting to see an uptick in actual trade activity on the secondary market in privates. Never existed, not even 5 years ago was it there, but today it is. And I think that market's only going to continue to grow. If you keep on, up on that industry, you'll see the traditional secondary market become kind of the front runner, the leader. Quickly followed up though with the decentralized finance secondary products. They'll come up out of the woodworks very soon as well.
How do the companies feel about that? I mean, do they? I mean, in the old days, if you had a company, they would not generally be jazzed about their cap table changing in between rounds. Are they okay with it these days?
Well, the old days, because it was impossible to track, but now that you can actually apply product to it and automation to it, they don't care. It's a very little learning curve. It's not that much to get them educated on what actually happens in the background and how it's simplistic for them and it's kept out of their hair. Once they've learned that, they are 1,000% comfortable. Because what you see in the past, when I've ran into some of these personally, companies would prohibit secondary transactions exactly for that reason, because it would screw up their cap table, and that can get them into a lot of trouble. Imagine, thinking that you had, James and Chuck on your cap table, but James and Chuck long sold their positions, and then they pay out James and Chuck on an exit, but they shouldn't have gotten it. Those people who are supposed to get it are going to be really upset and can sue very easily. But
Yeah.
today that can all be monitored and tracked, especially with the digitization of securities. That hasn't happened in any shape or form so much in the industry, but that will be a thing, I believe, in the near future. Then tracking becomes a real thing. It actually happens.
So from the company's perspective, it's probably a neutral. In some cases, it could even be somewhat of a positive, right?
Oh,
If they
it's
know
value added.
their people can have better liquidity, that's just more of an enticement, right?
It absolutely is. If they know that there's going to be a way to exit earlier than normal, they're totally going to be they'll be more aligned. They'll be more willing to make that investment for sure.
Excellent. Now, in the UK, there are, UK economy, for those who haven't been following it, has not exactly been a hotbed of innovation for many years. And the government realizes that and is trying to take some steps to change that. And one of those steps is a tax break, essentially, for investing in projects like you might find on republic.com. Could you walk us through that a little bit,
Yeah.
Chuck?
So there are three prominent ones: EIS, Edward India Sam, SEIS, and then there's also VCT. EIS and SEIS are typically available to any private company. And I'll boil it down very quickly. It is a very long law, tax code. But in effect, if you're an investor and you go into one of these SEIS or EIS companies, you can provide a form which the platforms who are offering those companies out to their investors typically have automated. So you have your account, you make your investment in one of these SEIS or EIS available companies. They spit out a form, you mail that form or digitally mail it to your government, especially in the UK, and you get 20% back. So if you make a $100 investment, they'll send you $20 back to your bank account, and you've already de-risked by 20% your investment if it were a $100 investment. If that company were to go on and fail, this math is not correct. Again, you should consult your tax advisor and your accountant, but it ends up being about another 30% that you get back on a failed company. You've effectively de-risked your investment by 50% out of the gates, which is
It's
just
a pretty
unheard of.
amazing deal.
Yep.
Yeah, that's a nice perk.
And then VCT would be if you're investing into a venture capital fund. Those are a little bit harder to come by. It does require a lot of like manual lift from the venture capitalist side of things. So you're not going to see those too often, but if they are available, you obviously have a pretty great tax incentive to invest in a venture capital fund as well.
Now, shifting gears from logistics to actual investing, because obviously the reason people are doing this, they want to make money. And in general, I mean, these are small companies. Many of them are going to fail. That's the way it works with early stage.
Yep.
But the ones that do succeed, hopefully, will more than pay the bills for the ones that do fail. So in other words, you're accepting a reasonably high probability of loss, potentially total loss, in exchange for the potential probability of a really, really big gain, right? That's what we want. And I peeked at your platform, and you've got all kinds of, which I'm guessing is representative of most of the others, in consumer products deals, medical deals, just all kinds of stuff. Really, it's almost agnostic to industry. You got a wide variety. Are there any pointers, like if someone jumps on here and says, "I want to find some deals," like you guys pre-screen to some degree, I'm guessing, to make sure you got at least legitimate companies registering. But in terms of like, what kind of advice would you give? Let's say a relative says, "Hey, Chuck, I'm going to sign up. How do I pick the winners?" What do you say to that?
Do not make one investment. Come into this with a plan. You'll want to have a long-term plan, that is, meaning I'm going to invest $5,000 over a 6-month period, or I'm going to invest $20,000 over an 18-month period, and I'm going to sprinkle it around. I want to find a biotech company. I want to find a CPG. I want to find a revenue share deal. I want to find a debt deal. I want to find a moonshot deal. That's an early stage equity company that could go to the moon and back if it does well. So coming into it with a plan, don't put all of your eggs in one basket. Spread it around, and then you'll have that that portfolio effect that you just mentioned about. Some will fail, some will do well to make up for the others, and then actually give you a positive return. If you go into it and you're like, heck, I'm just going to put in half of what I expected to invest in this one company because it looks super interesting or hot to me. I think, I maybe I know the founder or my cousin's involved in the company or something like that. It's not going to pan out well. You do not want to concentrate your investments in the private. You shouldn't concentrate your investments in the public markets either, but it's especially important in the privates.
Yeah, I ran a dividend newsletter service for 10 years, actually, in the US, 5 years in London. And even for dividend stocks, I would tell people, you got to diversify. Whatever you come in, you don't just buy the most exciting thing. You got to spread out. It's even more true with this area. And just to, I guess, put in a plug for this industry, in the old days, let's say you had, $1 million to invest in a private deal. Like if you're a retail investor, maybe you got one chance at one deal, which is super risky. But now you could take that $1 million. It doesn't even need to be $1 million now. You could have $10,000 and spread it across, 10. A lot of these average deals are $1,200, $1,300 per investment. I mean, that's just like a
Less.
stock,
I mean,
basically.
100,
Yeah,
pound, $100 to get into
yeah.
the
It's
company.
so. I mean, the point is, it's fully possible. In fact, it's
Yep.
quite easy to diversify now, uh, thanks to this system. What do you think is going to happen in the future, Chuck? I mean, in the old days, we had public markets for a reason. We have an investment banking industry for a reason. We have exchanges for a reason, and it seems like with technology, it's already changed. Like if you go to the New York Stock Exchange, I mean, it's kind of a ghost town, right? People just walking around. It's not like it used to be because of technology, right? Private markets have just exploded 10, 15, 20 years. What does money raising look like?
I think it continues to compete. Private continues to compete with the public market. The private market is substantially larger than the public market, believe it or not, and they just haven't had a proper place to live with a proper structure or product to navigate it. You're starting to see that today. You'll also probably see companies stay in private mode than ever before. The mentality of founders today versus say founders in the 80s, 90s, even early 2000s was to go public as soon as humanly possible. That was the way that they could, bring things for themselves personally to fruition. Today, a little bit. Tomorrow, for sure, I think you'll start to see the secondary markets, take that over for them in their mind. Hey, I can actually have a liquidity event in the secondary market. I don't need to go public, which is a huge pain in the butt. It's going to cost me and my stakeholders, shareholders, a lot of money. It's going to be a lot of brain damage. It's just not that efficient. So they can use other rules and other regulatory securities exemptions within the local, locale that they're in to take advantage of basically product innovation. And it all comes together and all is glued together if there are proper secondary platforms and activity out there. So that is a huge order. I don't think, that's a guaranteed, but that's where I see the market headed. And I know a lot of people are demanding for it to be a thing, and that's what we're trying to do.
Well, I think it's true. I mean, the number of public companies has been dropping, I think, at least for 15 years, maybe for 20 years. Something like 15, 20 years ago, it peaked, right? And that's been,
Especially in 2022.
yeah, exactly. Yeah. Going down. I mean, companies are doing, practically doing zeros now, right? Why go public? It's expensive. There's a lot of
Yeah,
hassle. We just
you're
don't
even
need.
seeing in the U.S. markets, you have in the crowdfunding industry, you have companies who are public that are utilizing private securities exemptions to raise capital because it's less expensive and it's faster for them to do it through the private markets than it is for them to do it through the public markets where they already live. It's crazy.
Which is almost an embarrassment to the public market system that it's
Yep.
it's so much easier to do something else.
It happens. Real estate investment trusts. It happens on a daily basis. Real estate investment trusts who have been using the public markets for the last 25, 30 years, and they do it 2, 3, 5 times a year, have now gone to a securities exemption in the U.S. called Reg A because it's easier for them, and they can do the same thing. They can raise the same amount of capital. It's nuts, but it's happening.
Yeah, private markets are kind of halfway or maybe more than halfway to the new public markets. But that brings up another point is, if you look for, search for crowdfunding, you see republic.com, you see WeFunder, you see, Fundrise for real estate, you see a bunch of different platforms.
Yep.
What does the future look like? I mean, is it going to be a winner take all? It's going to be kind of an, oligopoly, you got, 3, 4, 5, 6 kind of players, and that's it. I mean, public markets have just a few securities exchanges per nation, really. Is it going to go the same way? And then the minor logistical question: if somebody buys a share in a private stock through a platform that one day becomes defunct, does that person need to worry?
So a few things happening there. Let's get to the worried question first. By law, we're required to utilize transfer agents and record keepers, and even sometimes custodial banks, depending on the offering that's being made. There is always going to be another record and another responsible entity, but based not just the regulators making them responsible, but local government, especially state on custodial deals. So there's going to be a record of the activity. They can't just walk away from it. If the company were to, if the platform failed, the company couldn't just walk away from their investors and say, well, there's nothing we can do here because it happened all on that one platform. No, that doesn't really happen. There would be transfer of control and transfer of information. So at least in the US and the UK, I know the regulators went through a pretty heavy process in making sure that was the actual case if that were to happen. So there's some
Got
comfort
it.
level there in my
And in
mind.
real life, probably a bigger, more dominant platform will almost certainly buy the assets of the failing platform anyway.
Yeah, and you've actually seen that a couple times already on a limited level. Even at Republic, we acquired a video game investment platform, a real estate investment platform, and a small and medium-sized business investment platform to help us spread our wings to get action and activity and revenue share and debt deals and later stage companies,
So
etc.
you are the
But
Pac-Man
we
of the
had to acquire those
yeah.
past companies they raised capital for, and we are responsible for any distributions or of dividends or revenue share and exits when they've happened. We've had to actually collaborate and work with the transfer agent that's ultimately responsible, and the custodial agent is ultimately responsible for getting capital back to the investor. Why? And I mentioned it earlier. Digitization of securities, taking things to the blockchain, is wildly important because it makes that world a heck of a lot easier and less likely to breaking down.
Got it.
And then where I see the industry going, I think you'll probably end up seeing a few really sophisticated specialists living a long life in this industry, meaning they're only going to focus on one particular industry because that's their background and what they're experienced in, probably in things like biotech, where they're focused solely on a very complex industry. You'll see some conglomerates who take on features like banking capabilities, who have proper secondary markets, who are effectively the modern day investment bank. The ones who are not innovating at that level, whether it's super sophisticated or had modern day investment bank, they'll probably be acquired and absorbed into, if they're good, into some of these trading houses like a Charles Schwab or a TD Ameritrade, something like that, because they're going to eventually want their clients to have better functionality and access to them. They have access today, they'll want them to have greater access to it.
Yeah, I was kind of wondering why wouldn't a Schwab or Fidelity, whoever else, want
Yeah,
this also, right? Yeah, it makes sense. So
they
they would
still have
probably
a
get the
lot of
more mainstream.
a lot of internal compliance issues where they've been in a rut for so long, focused only on the public markets, and you bring in a private, it's almost like throwing a wrench into the spokes, and they're like, what, whoa, we can't do this private stuff. It's regulated exactly the same as your public markets, but no, can't do it. So, but those barriers are starting to break down, and you're starting to see where the asset managers, the private wealth companies of the world are going, is they're first attacking the accredited investor space, and they're only going there. That's where they're kind of cutting their teeth before they open up the floodgates to the retail environment, the non-accredited folk.
One thing I've learned in life is never underestimate the difficulty that big companies have with
Yeah.
pivoting. There's a lot of inertia.
Yes.
So, but it's good. I mean, this is competition. This is between the crowdfunding companies like yourself and between the big platforms, between private markets, between public markets. I mean, I think it all leads to a good place at the end of the day.
For the investor, one of the competition things I actually meant to bring up earlier was, as there's better product market fit, you're getting higher and higher quality companies who are coming into this world and utilizing it as a tool to raise capital. But that means the end result is that investors are also seeing higher and higher quality companies. And as a platform, I can't tell you how many times, I'm sure we probably have 5 or 6 of them going on right now, where we'll get just randomly an application from 5 similar companies. What does that mean? We're going to put forward the one that we think is the best out of the 5. What does that mean for the investor at the end of the day? They're going to see, without having to go through that, one company that was based off of the other 4 not being as good, and they couldn't compete. So you got the best and most competitive deal that we could offer for that particular type of company.
And for the investor's perspective, from their perspective, it's good. It's reassuring to me to hear that, because it sounds like you have ample deal flow, enough that you can be picking and choosing. You're not just desperate to get anybody on the platform, which
So
makes me feel a lot
globally,
better.
we'll have I think it's over 30,000 this year to date of applications.
Wow.
And I
Wow.
mentioned globally we'll be in the 500 range. So it's not many that actually go forward.
So 30,000 boils down to about 500 live deals that go live on
I'd
your
say
site.
30,000 boils down to 1,000 that we would like to move forward. And then for whatever reason, a lot of times venture money or institutional money will come in and cut them off at the pass and say, hey, here's $1 million check. And they're like, sorry, crowdfunding folk, I'm just going to use this money now for the next 18 months. I'll see you in 18 months if we need it. But we're getting competitive there too, where we can offer more than just a check. And that's why you see like the venture capital model moving from, they used to just be a check to now they're offering platform services. They're bringing actual value outside of the check to their portfolio companies as an attractive feature to get them to move forward with that company, that venture fund, because they otherwise wouldn't get the deal if they can't offer more value. So we're able to offer value at scale with the crowd backing it. That's a super power. Like if your network came into this and they all wanted to team up together, that's a pretty big force to reckon with. They all say, hey, we're all on the same page and this is what we want to see done. That's a voice that founders and companies would listen to, and they can make markets move just by collective thought. So
Yeah, technology has really opened up a new era in finance. We saw it kind of in a weird way with GameStop, with people rallying together to, I'm not going to call it market manipulation, but it was, one almost that in a weird way. And then,
yeah.
of course, in real life, the institutions picked up on that. And they're the ones who really carried that. That's kind of the missing story there. But in this case, I think it's more benevolent in the sense that, people banding together. I mean, there's a economic benefit, and there's also a marketing benefit in the sense that it helps companies advertise. And I think that was originally a main reason people would do crowdfunding, is they could, kind of like going on Shark Tank. People notice you. It sounds like you're getting companies though who are, not just in it for the marketing reason, but they're just looking for capital raising, which I guess is a sign of maturity
Yep.
in the offering as well. Yeah.
Yeah, you see a lot less fluffy reasons why company are moving forward. There's a lot of the stereotypes that were holding the industry back in 2012, even 2015, even up to like 2020 have dissipated. Again, that at the end of the day, it just means better and better companies and opportunities for investors. We in 2016, there's no way in the world we would have been able to offer up a revenue share deal or a debt deal or anything outside of like a Silicon Valley early stage tech type deal. Now you're seeing, late stage, we will be, not only can they, tell us, but you can go and publicly find out that they've already made like an S1 filing. They're going to be going IPO in 8 months, 6 months, 4 months, whatever it may be. But they wanted to have one last pit stop for the non-accredited folk, for their community, to get in and to appreciate the upside potential when they do go IPO. So that's another path to crowdfunding that involves exits at the actual public level.
It's fascinating to me just from a theory standpoint. I mean, I really think in 10 years, 15, 20 years, there's going to be much more of a merger between public and private markets. It's more just like going to be a totem pole or a gradation rather than black and white. It's going to be scalar, not binary. And I think that's good. And I think that moves the world forward. And it brings a lot of liquidity to companies who need it, and investing opportunities to investors who want that.
Yeah, I mean, you're already seeing it. Who's at JP Morgan Chase this week announced it. They had it in stealth for probably a year, but they've announced the opening of a platform to help private companies raise capital. Now they're not going as far as investment crowdfunding, but they're starting to notice that they're losing business, and they're starting to notice that they're losing relationships. So they want to put a stakehold back in the ground. I wouldn't be surprised one day either. I'm actually wouldn't even be. I would be surprised if it didn't happen. Me waking up one morning, pulling up, the New York Times or whatever, my publication favorite is at the time, and seeing that, NASDAQ and New York Stock Exchange has opened up a platform for private companies to raise capital.
Totally.
It'll happen.
Totally. Well, I mean, in terms of doing good for the world, for the economy, and I always say capital market or financial market works best when it channels money from people who have money to deserving businesses who need the money, and obviously away from undeserving bad businesses. And the evolution of private financing, I believe, is a step forward to doing that. I believe it's going to accelerate human progress. Is kind of a big way to think about it, but it does move the world faster, and I think that's a good thing. So, Chuck Pettid, thank you very much for joining us. And if someone wants to learn more, I guess I'm answering the question as I speak it. Learn more about Republic.com. Where can they go? And I think the answer, as I said, Republic.com. Right? Is that?
That's correct.
I guess the best website, and diversification would be your main piece of advice for someone looking to get started, which is really always good advice for anyone looking to get started in any aspect of investing.
Absolutely. Crazy today, obvious tomorrow. Do your homework and you'll be fine.
Wise words, well spoken. Chuck Pettid, thanks very much for joining us. And thanks to you guys, as always, for watching at home.
Hi there. I'm Brian Christopher. My team and I write the Follow the Money investment newsletter published by SouthBank Research. It's a fantastic letter, though I may be a bit biased. We've heard some murmurs of a temporary market bottom. One reason why is because of a 19 October report from the U.S. Federal Reserve which showed inflation pressures may be easing. Then, on Friday, 21 October, certain Fed leaders said the group is starting to talk about planning to end rate hikes. That's all the market needs to hear to believe the Fed's and maybe other central bank interest rate hikes may slow. So let's say this is a temporary bottom. What should you buy? Well, when shares rise after they've fallen a lot, one way to make a lot of money is to buy the stuff that's fallen the most. Sounds silly? Hear me out. If the shares that are down have fallen for temporary, fixable reasons, they often come back. And I'm not saying you have to buy these things and hold them forever. You can just buy them for that first blip higher and line your pockets with some profits. For example, here are the 5 worst performing stocks in the S&P 500 index in 2021. See the column on the right. I looked to see which of these companies had insiders buying during their weakness. By insiders, I mean officers, directors, or large owners of company shares. 2 of our companies had insiders buying shares. For the first, payment technology firm Global Payments, ticker GPN on the New York Stock Exchange, shares rose 12% during January of 2022, while the S&P 500 index fell 4.5%. GPN has continued to outperform the index through 21 October, though both are down. The other name that had a lot of insider buying is an even more intriguing story. When video game maker Activision Blizzard, ticker ATVI on the NASDAQ, was falling in 2021, 2 directors reached into their pockets to buy more shares. Then, on 18 January of this year, Microsoft announced it was buying the company, and the share price jumped. This is an example of the investing mantra, sometimes things get cheap enough. Microsoft thought Activision Blizzard was too cheap, and often insiders can lead us to these situations. Activision Blizzard spews cash. Its free cash flow has been positive every year since 1998. I'm sure that's one of the things Microsoft likes about it, in addition to being able to bundle the games of the 2 companies and to learn from each other. These are the kinds of names we bring to subscribers in my Follow the Money newsletter. So what do we have today? First, online grocery solutions provider Ocado Group plc. It trades under the ticker OCDO on the London Stock Exchange, and it's been a dumpster fire. More broadly, UK shares rose after the COVID bottom, and the FTSE 100 index peaked on 8 April of this year. Since then, it's down more than 7% after dividends. Really, that's not too bad given the environment. Ocado is the worst performer in the FTSE 100 since the peak. It's down 61%. But there are some believers. Take a look. One insider in particular, director Jorn Rousing, still likes the name. He just bought £7.4 million of shares in mid-September. A trust he's a beneficiary of now owns more than 10% of the outstanding shares. Rousing believes, and shares are cheaper. They're down more than 83% from their September 2020 peak. I suggest you do more diligence on Ocado, however. First, Ocado does not generate positive free cash flow. This isn't the end of the world. It's perfectly fine to invest in companies that are growing their free cash flow, seeking to achieve break-even status. We want to see progress. We don't require perfection. In addition, U.S. grocer Kroger, ticker KR on the New York Stock Exchange, is one of Ocado's largest customers. Kroger just announced a deal to buy one of its largest competitors, Albertsons. These are the first and second largest supermarkets in the U.S. It's possible the regulators will force the companies to sell some stores or operations. Ocado currently runs 6 customer fulfillment centers, or CFCs, for Kroger. it has announced 16 locations and may build even more than that. It's likely Ocado will be affected by this deal, but it could be positive or negative. I believe it'll be positive. I think that the shares have priced in a bit too much negativity right now, but this remains to be seen. So long-term investors should stay tuned. For traders, though, Ocado recently bottomed at 380 pence on 13 October. It's already back near 480 pence, up 20%, more than 20%. That's a big move in a short period. If you like to trade quick moves, there could be more to this one. As for another idea, the Solactive U.S. Housing Index peaked at the end of last year. Since the end of the year, the index is down 36%. Mortgage lender Rocket Companies, that's RKT on the New York Stock Exchange, is the third worst performing member of this 35 stock index. Like Ocado in our previous example, it's down a lot too. It lost 51% after dividends. Housing has been hit hard, and Rocket is the largest mortgage lender in the U.S. As interest rates have risen, volume is down. It can't make as much money in this environment. That said, when rates stop rising, business will improve, and that's what two of its executives are betting on. Jay Farner is the CEO of Rocket Companies, and Matthew Rizek is a director. This year alone, these two insiders have bought more than $30 million US in Rocket shares with money from their own pockets. Farner started buying first, and he buys the most. He's purchased 3.4 of the 3.64 million shares the duo has combined to buy. As you can see, they buy every day. They believe in the company. I believe they believe that Rocket will take market share during these down days for the market. And when interest rates settle down, the company will own a bigger piece of the mortgage pie in the U.S. This is what Farner said in the company's second quarter earnings call on 4 August, and I quote, "This is an energizing time for us. Our ability to constantly innovate to serve our clients better through our platform, particularly during these challenging times, will further differentiate us from our competition and will allow us to capture market share over the long term." End quote. You can see Rocket shares are down. Excuse me. And if you want to learn more, look into the company. Find the 4 August earnings call I mentioned. Farner and his CFO are quite excited about the investments they're making in the company's future. And there's something to be said for putting your money where your mouth is. I've presented 2 ideas that have some merit. Not because I say they're good ideas, but because people who already own a lot of shares and are in a position to know say they are. But what do you say? What do you think about insider buying? Do you ever use it? I encourage you to look into it. You simply never know when another Jay Farner is going to go on a buying spree. And that, my friend, is useful information. Thank you for watching.